Cancellation of debt income is a critical area on the exam, and it almost always begins with a taxpayer receiving Form 1099-C. The general rule is that when a debt you owe is canceled, forgiven, or discharged for less than the full amount, you have taxable income equal to the canceled amount. For instance, if a credit card company settles a $10,000 debt for a $4,000 payment, the taxpayer has $6,000 of cancellation of debt income. The exam, however, will not focus on the general rule. It will test the exceptions. To remember the main exceptions, use the mnemonic BIQ, QS, which sounds like bikes. B is for bankruptcy, I is for insolvency, Q is for qualified principal residence indebtedness, the second Q is for qualified farm indebtedness, and S is for certain student loans. Let's break down the two most heavily tested exceptions, bankruptcy and insolvency. A common exam question will try to confuse them. Debt canceled in a Title 11 bankruptcy case is never included in your income. It does not matter if the taxpayer becomes solvent after the bankruptcy proceeding. If the cancellation is part of a bankruptcy plan, it is excluded, period. That is a key, absolute rule. Insolvency is where the exam lays its most difficult traps. A taxpayer is insolvent when their total liabilities exceed the fair market value of their total assets. The key is that this calculation is made immediately before the debt cancellation. The amount of canceled debt that can be excluded from income is limited to the amount of insolvency. Let's use an exam-style example. A taxpayer has assets worth $200,000 and liabilities of $230,000. They are insolvent by $30,000. A creditor then cancels a $45,000 personal loan. The exam will ask how much must be included in income. While $45,000 was canceled, the exclusion is capped at the insolvency amount of $30,000. Therefore, the taxpayer must include the remaining $15,000 as taxable income. A common distractor answer will be the full $45,000 or zero. Watch for facts that give you assets and liabilities. This is a direct signal to perform the insolvency calculation. Another critical component is Form 982, Reduction of Tax Attributes. Excluding cancellation of debt income is not a free lunch. For insolvency and bankruptcy exclusions, the taxpayer must reduce certain tax attributes, which can increase future tax liability. The exam may test the specific order of this reduction. It starts with net operating losses, then general business credits, minimum tax credits, capital loss carryovers, and then basis reduction in property. The basis reduction itself starts with depreciable property, then land used in business, then other business property, and finally, personal use property. The Qualified Principal Residence Indebtedness, or QPRI, is another major exception. This applies to acquisition indebtedness on a taxpayer